Many people like to receive a regular income from their investments, often in retirement or maybe as a passive income stream to meet other goals. And many ETFs are designed with higher dividends or income as a specific fund objective to help achieve this. So, having looked at some of the more regular dividend ETFs in previous videos, I thought it would be interesting on this occasion to take a look at two ETFs that are currently providing massive yield returns from either equity dividends or bond interest, and which could be a great addition to portfolios for those who are seeking a regular income from investing while still wanting their assets to grow. But before starting, I need to remind you that this is a financial education video and is not to be construed as financial advice. The two ETFs featured have been chosen because of their impressive recent yield figures, but that does not necessarily mean that they will continue to perform well, as past performance is not an accurate indicator of what will happen in the future. And just because they are high yielding does not mean that they are suitable for you as an individual investor with your own individual circumstances. Consider your own financial objectives and do your own research before making a decision on investment choice. The first ETF featured today is potentially attractive because of the current high dividend yield it is providing, with strong overall current returns, and is a Global X Super Dividend UCITS ETF distribution with a ticker of SDIP. This is a passive fund with a fund charge or TER of 0.45% that seeks to track the selected global super dividend index. It has a large fund size of 377 million sterling and adopts physical replication as a means of tracking its index, meaning that it actually holds all of the constituents in the index. The selective index tracks stocks with high dividend yields from around the world and includes high-yielding companies from emerging market regions such as Latin America and Asia. High yields can sometimes signal financial distress, so don't necessarily take the performance figures as a sign of individual company success. But with that being said, this is an ETF and therefore does provide diversity from the potential shortfalls of individual companies, regions, and sectors, with there being 100 holdings overall, with many based in developed countries, and who therefore are less likely to be impacted by geopolitical and currency risks, which are synonymous with the emerging markets. This fund's inception was February 2018, and since 2023, it has provided double-digit dividends, with a high current dividend yield of over 9% so far this year, and a potential to reach double figures once more. Dividends in this one are paid on a monthly basis, providing a regular income stream, and more regular than many ETFs who pay out quarterly. Overall year-to-date returns are a very healthy 15.15%, but please bear in mind that although seemingly very nice, this is the total return and incorporates the dividend figures we've mentioned. That being said, according to JustETF.com data, it has better total year-to-date figures at present than with other popular global equity ETFs such as the Vanguard, FTSE, or World ETF ticker VWRP, for instance. The risk profile is in line with what you would expect of a 100% equity ETF, as seen in the one-year volatility and maximum drawdown data. The one-year volatility figure shows the degree of price movement, and the maximum drawdown shows the largest peak-to-trough decline, or the worst loss experienced over the relevant period. Going back further in time, if the data exists, should help provide a better idea of the ETF risks, and these figures are not dissimilar to popular global ETFs. And these figures are more likely to be relevant if needing to sell assets in the shorter term rather than in the long, as the risk of selling at a loss in the shorter term is higher with more erratic price movements. The second ETF that is featured here today is one which uses debt instruments, or bonds as they are better known, to provide a high income yield from interest or coupon payments the bonds provide, and is a UBS, JP Morgan, US dollar denominated emerging markets diversified bond 1 to 5 UCITS ETF, sterling hedged. This comes with a ticker of UBXX and is a passive and distributing ETF with a fund charge TER at 0.38%, but with a much smaller fund size than the first ETF of 6 million sterling, which would be one of my first considerations as I balance the risk of exposure to this against the potential reward. And with both of these, I would personally seek a satellite or smaller exposure rather than making either the core to my portfolio, as they do come with risks that are not completely compatible with my more cautious attitude, but what you think might be different. With smaller funds comes the higher chance of closure, which does not mean that you lose your money, but could mean inconvenience, along with time being lost in the market, as you have to spend time to research new investments to reinvest into. The other risk with smaller funds would be liquidity, with fewer buyers and sellers, making it harder for you to exit your position quickly, and with higher bid-ask spreads, making it more expensive to trade. The index tracks the JP Morgan US dollar emerging markets diversified 3% capped 1 to 5 sterling hedged index. This tracks shorter dated corporate and government bonds from emerging markets with mixed ratings of between 1 to 5 years in duration. It adopts a physical sampling method of replication, so instead of owning all the constituents, it owns a selection of the more relevant to meet its objective of accurately tracking the index. With 100% emerging market exposure comes the increased risk of individual companies or governments defaulting on their bond loans, and with the potential of currency devaluation of certain weaker economies that will affect interest rates and inflation, which then impacts the price of the bond. Many of the bonds held are below investment grade, meaning that they are less creditworthy and carry a higher risk of default, which is why investors demand the high yield that this ETF provides for the risk they take on. Although UBXX focuses on short duration bonds of 1 to 5 years, which are generally less susceptible to inflation and rising interest rates, such conditions can still negatively affect bond prices, but to a lesser extent. No actual figures are provided for the effective duration or aggregate duration of the bonds held within the ETF, but the average duration is estimated between 2 to 4 years. Emerging market bonds can also be hard to trade, especially during times of market stress, reducing liquidity and leading to wider bid-ask spreads or difficulty exiting positions quickly. The bid-ask spread is the price you can buy a share for and the price you can sell it for. So the wider the gap, the more expensive it could be if you decide to buy and then sell in a short time. The top 10 holders make up about 8% of the ETF. This is a lot less concentrated than many of the ETFs out there, as you will see when doing your research, so therefore potentially provides better diversity with lower concentration risk, especially as the maximum size of any holding amongst the 700 total within the fund being capped at 3%. This one can be a very powerful tool for yield-seeking investors, but it's probably best suited for those with a moderate to high risk tolerance and a clear understanding of how emerging markets dynamics can affect share prices. One-year performance figures are a modest but reasonable 7.46%, but the current dividend yields are very high, massive 26.44%. The risk profile is lower than the last one of 3, and the fund comes with far lower volatility and drawdown figures. Although both provide inviting yields from either dividends or bond interest, this does not mean that they are necessarily suitable for you. When deciding on what is right for you, you should firstly take a look at your personal circumstances and what you are trying to achieve through investing. Your tolerance for risk, meaning how you would cope with larger falls in the value of your investments, coupled with your capacity to take risks, which raises the question of whether you can afford the potential financial losses investing in one of these ETFs could bring, should be in the forefront of your considerations in how much, if any, exposure you consider to these. Some of the points that I raised when looking at the featured ETF should also be things that you look into, such as the fund costs. Neither of these features are that cheap, but in fairness are in line with funds that include emerging markets and where inclusion of high dividend paying companies in the ETF is a primary objective. Also consider the fund size, diversity, liquidity, and currency class. Both these ETFs are US dollar denominated, even though they are traded on the London Stock Exchange in sterling, with only the UBS fund being sterling hedged. If unhedged, there could be more significant currency fluctuations as you convert that dollar into sterling to make a trade, which could add to the ETF's price volatility. But this is likely to be reduced if the ETF is hedged to your home currency. Please let me know what you think of these ETFs in the comment box below and tell me what you're invested in. And thanks very much for watching.